Hi, good afternoon, everyone. Thank you so much for joining today and taking time out of your busy afternoon schedules. I'm joined here today with my colleague, John Edgett, and we're hoping to share with you some useful insights on maximizing the enterprise value of your business and also preparing for the next stage of your business, whatever that might be. So we're hoping to run through this presentation in about 45 minutes and then opening up some time for some Q&A. Without further ado, I'd just like to introduce the two presenters today. So my name is Johan Tommy. I'm the National Leader of Value Creation at M&P, and I lead a great group of people at the firm. And what we do is we actually go into businesses and find the inhibitors of value within those businesses and either eliminate them, mitigate them, and allow our clients who are entrepreneurs realize that hard-earned value that they've taken decades to create. John, I'll let you introduce yourself.
Thank you very much, Johan. I thank everyone for joining. My name is John Edgett, and I'm a partner with corporate finance team at M&P. I cover Southwestern Ontario, very broad range of industries and sectors, and work closely with all the professionals in our firm to help deliver solutions to clients. And primarily our business focuses on divestitures. We also engage with clients to assist on acquisitions and raising capital. So it's a pleasure. Thank you very much.
So I think one of the things that I'm very proud of at the firm is we really have an integrated value enhancement approach where we use different service lines and different leaders and the firm to take a look at businesses and unlock that value. And no business is the same. So, we have accounting and tax professionals, we have enterprise risk and technology professionals. Many a times, risk in your business or technology debt is something that will hold it back from really realizing that full value. We have strategy and human capital people. Human capital right now is a key issue in the marketplace. What is your strategy to retain? What is your strategy to acquire top talent? Value creation and succession planning. This is where we're going to be focusing most of our time here today, along with corporate finance that John's a part of. And John will share with you real stories, trends in M&A, and also go through some really great valuation multiples. That's the part that I quite enjoy. Corporate restructuring, and lastly, we do have some valuations and litigation support. Sometimes as businesses are going through interesting aspects of transitioning, there is some litigation, unfortunately. A little bit about M&P. We are the preeminent mid-market firm in Canada. We have about 125 offices, 8,000 plus team members, and we are very local and focused. So we have people on the ground across all these locations, big and small town, Main Street and Bay Street, and we have a coast-to-coast reach. We see that as a real strong competitive advantage because we understand the markets that we do business in. So some learning objectives today. So we want to share with you some pragmatic steps to maximizing enterprise value. We also want to share with you some succession strategies. And, we find that usually there's a host of them. We want to pick one that is right for you personally and one that's right for your business. There is no one size fits all, and we're going to take you through the most common ones today that our clients seem to deploy in their business. We're also going to talk about transitioning the business to the next generation and some useful tips and tricks that you can take advantage of. As a quick note, if you are thinking about taking notes and writing all of this down, you don't need to because the presentation will be shared with you. We'll also be talking about transitioning the business to your management team, or if there's a private equity buyer, what does that look like? Or if you are a private equity firm or you are wanting to launch a consolidation effort, what are some things that you might consider doing? And then John is going to be talking to us about M&A transactions in various sectors. We're going to focus in on the bulk of the sectors represented here today. And so, if we don't hit your sector, we can certainly set up a time and have a discussion outside of this. So we wanted to start off by actually talking about enterprise value. And, I asked for forgiveness for some of you that may know how this works, but a lot of the times we find that clients are learning about this and learning about how this works as they go through an acquisition. It's really useful for them to understand how this works before an acquisition, to understand what drives value in their business. So this is a very linear example. It's a very simplistic example, and we're going to go through more complicated enterprise value examples later, but I'm starting off at the ground level. So typically when someone looks at the business, they say, hey, what is your EBITDA? And your EBITDA essentially is earnings before interest, tax, depreciation, and amortization. So you take your net income and you add back your depreciation, amortization, interest, and that is your EBITDA. So it's also called the free cash flow in the business. And every industry has some sort of a multiple that they're valued based on the EBITDA. So for this example, I'm going to use a multiple of 4. So typically you take $1 million in EBITDA, you're in an industry that you're operating on 4 times multiple, your business is worth $4 million, right? Wrong, because you need to consider one more thing, and then one more thing is goodwill. Who owns the goodwill? How sustainable is your EBITDA when Jim and or Susie leave the business? Jim and Susie being the entrepreneurs. And so if all the goodwill is within Jim and Susie, and they have client relationships, or they have that genius gene in terms of running the business, then you have to actually adjust the EBITDA for that. So in this specific example, we note that a quarter of the EBITDA is due to the ownership, and them having knowledge and relationships that would make it very difficult for any new owner to run the business and sustain profit at that $1 million. So in this case, it's you've actually got to take that out of the $1 million and times 4. So you're leaving. You should have had $4 million, but you're leaving $1 million on the table. And I can't tell you how many times John and I see this play out. And I think in a very simplistic standpoint, if all of us had a really expensive piece of real estate, we would definitely stage that real estate before we put it on the market for sale. The same logic applies to your business. You have to think about staging your business. You have to look at it from the point of view as a potential buyer. And what are some things that are going to inhibit value? And you want to address them before you put the business on the market. This is sort of a traditional approach and how people go through some sort of a corporate finance event. There's a letter of intent, there's a quality of earnings report where someone looks in at your financials and they're providing some reporting on it. There's financial due diligence. Then there's some negotiation. The other side's identifying some risks. There's discussion about earnbacks, key employees. I think looking at our client's point of view, you're interested in how do you maximizing enterprise value. You're interested in not having necessarily to stay for a 3 or 4 or 5 year earnout period. You want to, you want to enjoy life. You want to enjoy this new check that you're going to get, and you want to think about goodwill. So how tied are you to the business? How concentrated are your sales within a few customers? And then obviously the tax ramifications. How much tax do I have to pay if I structure the deal in certain ways? So this is the same company. And you'll see in this company, EBITDA is still $1 million, as was in my previous slide. But the company's done something to actually earn a multiple at the top end of their sector. So there's usually multiple ranges. So in this case, it's 4 to 6 in my example here. And again, this is a hypothetical example. And the ownership has done something to actually transfer the goodwill, the genius, or the sustainability of the profit from being heavily reliant on the ownership or key employees or key customers to the business now runs a little bit more on remote control. All right. And when that happens, you can actually experience all that value and cash that value in. And so in this case, the theoretical value of the business is now $6 million, 6 times 1 million. But enterprise value has doubled. In the previous slide, enterprise value was 3 million. Now it's 6 million. And all you've really done is you've moved goodwill and you've made your business more sustainable, and so you're getting a higher multiple. And we see this happen all the time with businesses that have quote unquote staged themselves to sale. So I want to take pause here, and Jason, you're going to be launching some polling questions. So I'm going to take about 15 or 20 seconds here and just allow you to go through some polling questions here. We'd like to understand what many of you in the room are going through, and what are you hoping to learn, and where are you coming from? For those of you that are following on the phone, we're asking 3 questions. The first is, what is your primary reason for maximizing enterprise value in your business? What is your primary reason for maximizing enterprise value? What is driving you to do this? Number 2, what are you most concerned about in your business over the next 12 months? And that question really is geared towards those value inhibitors, where someone looking at your business may value you a little bit lower because there's increased risk. So what are you most concerned about over the next 12 months? And the third question is, as a business owner, how comfortable would you be having your management team run your business while you're on a 4-week vacation? So one of the things that, as business owners, I trust all of you see is everyone sees the top of the iceberg here, and all the products that you produce. No one sees the pain underneath the water here, and all of that, those decades of hard work, those long nights. And what you want to do is when someone does come in and they're looking at the enterprise value of the business, they do put on their diving suit and go underneath, and they are looking at what's under the surface. They are looking at some of the factors that make your business harder to run. And so these are the most common ones. Depending on the industry, you may have some other ones as well. So customer concentration. Are most of your sales concentrated with a selected number of customers? If that's the case, really, it's a little bit more risky for your business, for a potential buyer. The second one is, if you have stagnating sales or diminishing EBITDA. During COVID, there are a few businesses that unfortunately went through stagnant sales or diminishing EBITDA. There were other businesses that thrived. So if you were part of the supply chain, if you're a manufacturing business, if you're part of the food and beverage supply chain, your business generally boomed. Seasonality, right? So how much does seasonality impact your business? And then, can you flatten that? Because there are cash flow ramifications for anyone operating that business. Key person impact. This is obviously pretty critical. I can't tell you how many times John and I are sitting at a table and someone says, you know what, I have 2 really good people and they help me manage the company and I don't do very much. I've set up a good model here. And those 2 people are maybe 3 years away from retirement, and there's no real good succession plan under them. The last one, I think this is becoming more and more key. It's access to skilled labor. So this could be talent management around the company. This could even just be people that are working on a plant floor, and labor force participation is down about 9 to 10%. So that's key, with a lot of people leaving key sectors. So if you're in hospitality, for instance, this is something that you're really struggling with. If you're in construction, something that our construction clients are really struggling with. And each of these items present a risk for a potential buyer, and ultimately impact your long-term business value. Succession planning isn't just about selling, it's about making sure that you have things in place to pass it down to the next generation, and or you're preserving value as you continue to run the business. So we have a client that had a deal with a private equity firm, and unfortunately his business was in a sector that it was projected to go through a downturn. And one of the things he said to us is, he says, look, I've spent decades building this business. I want to make sure I'm preserving value, and I want to make sure when I come out of the recessionary environment in my particular industry, my value is intact, I have people intact, I have a strategy on talent acquisition, I have a strategy on customer concentration, and I can come out stronger and command a higher price. So are there any other factors that are relevant to you that you would like to bring up in the chat, which are key factors that are making your business harder to run and that we can unpack today for you? So I'd like to talk about some case studies and just some things that typically you would like to consider doing. Number one, revenue growth. So having a CRM is so critical, a customer relationship management software. So, this could be Salesforce, Microsoft Dynamics, HubSpot, could be a variety of things. Do you have your sales information and intelligence cataloged, and can you go back years where you can show why people buy from you? The sales process, where it's not as much voodoo, where you are showing that there is a process, your people are trained, there is strategy, you have great customer management, you have great vendor management, supplier agreements, and these are things that many of the companies that we service do have, but they're handshake deals and they may not necessarily have it written down, or it may be more informal. Well, these systems add a level of predictability and comfort to a prospective buyer, to a private equity firm that's looking to buy you, to another merger candidate maybe that you're thinking of merging with. The next is productivity and EBITDA improvement. And I think a lot of our clients are sharing with us that they cannot grow because they are essentially stymied by the labor skills issue right now. There just aren't enough people applying for jobs. They have a ton of jobs that are essentially unfulfilled. Well, one of the things that you can do is go into your business and look for productivity gains. Can we actually operate in a way where we can grow the company with the same amount of staff? You're showing you can actually generate more capacity. It's highly valuable versus someone coming into the business and saying, hey, you are tapped out. You cannot do any more revenue growth with the processes, systems, and people that you have. The other point here is staging a business for sale. Are you confident that you've maximized your EBITDA and balance sheet before sale? Are there opportunities to continue to tune your business so that you are enhancing that value? I'm going to go through 3 examples right now. This is a construction services company. I'm going to be not specific, otherwise you'd guess on the client. And we actually heard from the owners of this company. They said, I'm just not having fun anymore. They'd owned this business for a few decades. They'd handed it over to their general manager. The issue though is that the owners kept having to come back into the business and work really long hours because so much of the goodwill was housed by them. So they wanted to sell the business, and they brought us in to actually help them, quote unquote, stage the business. So we actually identified about a $500,000 EBITDA bump that, if they change the way they manage the company, if they change the way they schedule their crews, if they change the way that they dealt with customers, negotiated contracts, they could actually enhance the EBITDA by about $500K. The EBITDA at the time was about $2 million. As we continue to work with them over the course of about 6 months, we identified about $1 million and actually delivered it. So their financials actually improved by a factor of $1 million. And we got this by improving field productivity. Again, in the construction business, the big challenge is people. So we had to improve productivity by 20%, and we could actually take on more contracts with the same amount of labor pool. This was their biggest impediment for growth. The other issue that they had is they wanted to invest in new tools to run the business, but they recognized they had employees that wouldn't want to go through a full-blown ERP implementation. So we actually created semi-digitized tools for them that fit in really, into their culture. Not a one-size-fits-all approach, and it actually made them. This became a little bit of their competitive edge. They now had specific things that they were doing that gave them an edge competitively in the marketplace. Now, what's interesting is before we started working with them, they actually got valued at 4 times multiple. So if they were $2 million EBITDA company, 4 times multiple, they were going to get $8 million if they sold. And it's really interesting because when they went to market, the post-project value of the company was actually 7 times. So 7 times 3 is $21 million. Not much had changed in the company. We just tuned a little bit, gotten EBITDA higher. They'd missed some opportunities in terms of dialing up EBITDA in their business. And the enterprise value went from being $8 million to $21 million. Now, I was really surprised that they got a 7 times multiple because, I thought that the most they would probably get is about 6 times. The reason they actually got 7 times is because the prospective buyer was private equity, and private equity was going to use this company as a vehicle to consolidate other companies in the industry. And the reason they were actually willing to give them one more X, which in this case was worth $3 million, is because this company had great systems. This company could function with minimal management support, and they wanted to take these systems and essentially clone them into the other companies that they were purchasing. Supply chain, I think this is a really interesting story. We have a few clients in the supply chain space, and if you're part of it, you were growing through the pandemic, but a lot of them have actually been inhibited by have been inhibited in their growth by not being able to cash flow and buy new inventory. So we've actually done some really interesting work here in terms of navigating and redesigning the inventory management systems they're buying, their systems, their tools, and actually buying the right inventory, finding the ways to maximize gross margins, maximizing turns through that inventory. So we have a really neat technology practice and some really great consulting tools that we've deployed in a variety of industries: consumer packaged goods, casino and gaming, pharmaceuticals, industrial products, and we've been able to enhance the amount of turns that the company is experiencing, so that they can operate on the same amount of cash as they were and actually experience greater sales. We do everything here from inventory management to supplier negotiations, and these are all the things when you're looking at selling your business, you're looking at potentially maybe selling part of your business to someone else. These are part of those things that if they're not in place, they actually add more risks to the deal. So you want to take a look at them and you want to de-risk your company a little bit. Interesting story here. This is a client of ours. It's a global toy company, and they're based right in the Peel region. Or they were based right in the Peel region, and they decided to come together with multiple companies, and they had locations in Ontario, Florida, California, Hong Kong, and Philadelphia, and they essentially wanted to compete against some of the larger toy companies. And so they hired financial due diligence people. They went in and they found about $9 million in synergies if these 4 or 5 companies came together. And we actually went in to look at the deal, and we found an additional $4 million in synergies. Now, those $4 million in synergies is substantial because it flows to the bottom line. It allowed these companies to actually borrow more money, and they achieved these, this $13 million of synergies. And I think one of the things that's important is when you're launching some sort of an M&A strategy, or you're launching some sort of a consolidation, you want to actually have different advisors at the table. So you want to have people that understand HR. You want to understand people that have performance improvement or M&A background or tax implications, ERP selection. I'm using NetSuite, they're using SAP, someone else is using Sage. Which one do we pick? And so, this is critical because with the data shows us that something in and around 80% of mergers and acquisitions aren't successful. And I would agree that I would share with you, from my opinion, that most of the time that's due to these companies not having really a holistic plan and different sets of people with different skill sets to come in and speak to these things. Eventually, what we really created was a $250 million company with 7 mergers and acquisitions, and they came together, and we put these departments together, and they're multiple. Like I can't share this information because it's confidential, but I will share with you that the multiple post-merger was much greater than all those companies in the multiple that they would experience by themselves, because now they were being positioned to be bought by a much larger company. So I bring up consolidation because I see that there's some industries in the Canadian mid-market that haven't started consolidation efforts as yet. There's money to be made here. Great way to grow your business. It's easier to grow your business than doing it organically, but there are some pitfalls, and would be happy to talk to you about those pitfalls. But I'm going to jump into those of us now that are thinking about, well, I don't want to sell my business, Johan. Stop talking about selling my business. I want to transition my business. And here's some interesting stats in terms of how successful is business succession from Gen 1 to Gen 2. Well, it's about 30%. It then drops to 10% from Gen 2 to Gen 3, 5% from Gen 3 to Gen 4. I don't know what the stat is into Gen 5, but I think of the 200 plus companies I've worked with, I've only worked with one Gen 5 company, and that was very recently. What are some issues here? Well, the 3-circle model is a tool that I find really useful. So with our management teams, we have very specific descriptions, job descriptions, roles, responsibilities. Consider actually putting in roles and responsibilities for each one of these people. So someone may be in the business and they may be an owner and they may be family. So they're kind of in this part of the Venn diagram. Well, what are their responsibilities and how do they differ from someone that is in the business and a family member, but not yet an owner? So, how are they expected to behave differently, and what value are they expected to generate different to someone in these various aspects of the Venn diagram? And what happens when you're actually moving people in and out between circles? What happens when the person that started the business was family and an owner, now gives up ownership or transitions it out? What is their role? And we noticed that this is probably the leading cause to issues within family businesses, where they may have personal issues that come up because these things aren't well defined right from the start. I'm not going to go through this checklist, but I'll let you read through it later. It's just a checklist for ensuring that you're professionalizing this succession plan, and you can go through this later. So where do I go from here? On our website, and we will send this out to you as well. We have a 5-minute survey. It's industry specific. It helps benchmark some qualitative information about your business. It'll show you high level where those risk points are. What are those things that are going to impact goodwill in your business, that are going to impact value in your business? Number 2, John and I would be very open to having a virtual consultation with you in terms of what are my options. Maybe we haven't talked about a specific challenge that you're going through or a specific strategy that you want to implement. And then, we'd also be happy to do part 2 of this, which would be a more detailed succession and value workshop that jumps into some of the specific questions that you have today. So without further ado, I'd like to hand it off to my partner, John Edgett. John, it's all yours.
Thank you very much, John. And before I'm going to just pause here for 1 second, because I want to talk about a few things generally, then spend a little bit of time on 3 particular sectors: engineering and construction, manufacturing, and food services, selected based on our view of the participants, those who signed up to watch this seminar, and trying to target as many of your sectors as we could. But I would say we live in interesting times. So once everyone got used to the idea that COVID was real, what happened was the M&A started up again. So, and for the last year, it has been on a tear and continues to be. So there are a few things driving this. On the demand side, the balance sheets of strategic acquirers remain very strong. So there's a lot of money available to buy businesses, and the demand for growth for shareholders also remains strong, and acquisitions fast track growth. There's many other synergies and things that can be derived, but certainly it's about growth and getting there quickly. The other group of major group of company purchasers are private equity firms, and they are funded by pension funds and life insurance companies that have massive amounts of capital. Private equity has been a very good asset class for them. So the money available from institutions to private equity funds continues to pour in. And so there's another source of demand for companies. There's also, I guess, thematically, there is, I've never seen such a recurrent theme being to consolidate a fragmented industry. That's always been a reality, but it seems like buyers are able to see almost any industry as being fragmented and want to do a roll-up strategy based on that. So with those things having been said, maybe we could just move on to the next couple slides ahead, and I'll talk about engineering and construction. I'm not sure who can move that slide ahead. There we go. So engineering and construction sector. So there was obviously a decline during COVID, access to labor and just general uncertainty. But going forward, it looks like demand is going to continue fairly strongly. This is non-residential construction and engineering that goes along with that. I would say that some of the key drivers would be such things as the value of non-residential construction, supply chain issues, and costs and interest rates. The big issue that's happened with all of our clients and everyone in the sector and many sectors has been inflation and the cost of materials required to construct. And I think recently it was announced that inflation was 6.7%, which on the one hand seems super high. And on the other hand, based on maybe personal experience, which is dangerous, seemed to understate what inflation was at. I'm not sure about you folks, but I sure find that cost of things has gone up on average by more than 6.7%. But be that as it may, and that's, I don't think this is a short-term blip. So the Bank of Canada reacted, and the Bank of Canada has raised interest rates, and once has raised them again, and one will expect that to continue as they try to tamp down on inflation. But inflation is a big issue for businesses, particularly those that buy a lot of materials in the course of their activities. And the question becomes how much of the cost increase can be passed on. Often the answer is not all of it, which can create issues for many businesses. If we just go to the next slide, we have a summary of mergers and acquisitions in Canada and the United States over the last several years. Canada being the red, orange, and the United States being blue. And it looks up and down and up and down. You might say, well, how do I get any information from that? But if you look at quarter over quarter, that is, Q4 this year over last, and Q3 over this year over last, etc., is generally a positive trend, and which doesn't surprise me. But the buyers are mostly strategic buyers, and one of the big things they're looking for, pardon me, is access to skilled labor, which is a huge problem everywhere. But to the extent that your labor is more and more skilled, it becomes harder and harder to access them. Pardon me, folks. I was getting over a cold. The next page, we're looking at private equity. And the things that I like that it illustrates are that two themes. One is as the size of a company goes up, all things being the same, the value increases. And I think there's an implicit assumption that a larger company may be lower risk and have more sustainability. The other thing that happens is that more asset-light situations, that is an engineering services company versus a heavy civil and construction company, the asset-light ones tend to have higher values. And that's because of the necessity to reinvest in the business is less as the asset base is less. On the next slide, just want to talk about manufacturing and start off with the purchase managers index, which is what you see on the right. And surprising, I thought it would be good, but it was actually at an all-time high in March of 2022. It hit the peak, and so that is an indicator of purchasing managers stated desire to buy in the near future, and that's of course a function of the demand for the products and services that their company makes, and this results in a very compelling positive story, good for anyone in the manufacturing sector who supplies. And the next slide, like the one a couple ago, was about the volume of acquisitions in North America. And there was a huge decrease in the first quarter of this year. And I always want to caution people when you see something like that, that one quarter is not a trend. And who knows why that might be. But you need to take a look at a longer term period in order to really get a trend from this. I would say that while these are macro type of numbers, we're seeing within our own practice no end in interest for the acquisition of manufacturing companies. And the acquisitions are often driven by, cost synergies, the desire to get into a new geographic region, and again, access to labor, which is a big constraint for everyone.
So John, it's really interesting because it looks like the transaction value is down from 45 billion to 38 billion, so down 7 billion, but the number of deals has more than half. So it looks like there's some larger companies or larger deals happening.
That's it. That's exactly right. And you will get that from time to time where you'll see a disconnect between numbers of deals and the value of the deals. And, as it doesn't take too many big ones to swamp a number. So sometimes I like to look at these figures but I always like to talk to my partners in corporate finance and see what they're seeing also on the ground. And we are seeing absolutely no curtailment in interest to acquire manufacturing companies. Okay. On the next slide, we have some statistics on looking at manufacturing companies, and this is their growth for the last 12 months versus the next 12 months. And obviously there's a dispersion around the mean, but growing at 15% over the last year is a tremendous growth rate. Forecast 8.5%, still solid growth rate. One of the most interesting things I thought was the forecast, the historical versus forecast for automobile manufacturers. And not surprising, however, given that production of automobiles has been seriously curtailed by access to semiconductors. And that is sorting itself out through the supply chain. So anyone who's tried to buy a car recently has probably found out that there's very little inventory available. So it wasn't to do with demand, it was to do with the ability to produce. And that's being dealt with. So we expect a significant increase in automobile manufacturing over the next year and for several years to come. The next slide, looking at profitability. And this was just a slide that I wouldn't read into it other than to say this is great news. Overall, EBITDA margins at 19%, forecast to be higher. That's terrific. I found it actually a little surprising. It seems like a lot of manufacturers are being able to pass on cost increases and then some. So this is a real success story to be able to maintain profitability in an environment where there's scarcity of labor. Every single commodity has gone up a lot in price. So the way that this can be achieved is by efficiencies. Some of the things that Johan advises companies on is how these folks are being able to maintain, in some cases, improve their profitability. Next slide is looking at valuations, and I'll just need a minute to explain here. So LTM is the last 12 months, and enterprise value is the value of the company's equity and debt, and EBITDA is earnings before interest, tax, depreciation, and amortization. And so values based on trailing results are always higher as a multiple than forecast results. That's just the way the math works. But these are nice solid multiples. 12 times on the past and almost 12 times on the forecast. Sort of just supports the statement that there's these companies are doing very well. The demand for their stock, and these are public companies, remains solid, and it doesn't point to there being any particular reasons for concern.
So John, just asking a question here for our listeners. If you are a home building products company, which is right here, third from the bottom, and you have an EBITDA of $1 million, what does that mean in terms of value based on this report that you have here? It's not necessarily a professional opinion, but just based on the report, what does that mean?
That means 7.9 million for the value of the company, and the equity value would be 7.9 less the debt the company has on its balance sheet. Okay. Now, there's one major caveat for that, in that the companies that are behind each of these industry sectors are public and large. So you do have a premium for a company being larger, and you also have a premium for a company being publicly traded. So you can't directly apply public multiples to private companies. So sometimes people will apply a discount, say sort of 30% is not uncommon to apply that to a private company compared to a publicly traded company. But the other thing that's relevant with public company multiples is that when public company multiples are high, it means that they are it's much easier for them to do acquisitions, because what they are acquiring, they can offer good prices and still have it accretive to earnings, which is really important for them. Otherwise, they probably couldn't get an acquisition approved. So high multiples
John,
are enablers of acquisitions as well as positive indicators on prices being paid.
And John, you bring up a great point here, because I'm not saying this is the case all the time. Maybe you're a smaller company and you have IP that will change your industry, and that's going to drive value. But if you're a level set player in your industry, you're just the average player in your industry. You are able. I don't know if you guys caught that point. These are public companies; they're larger. Your multiples in most cases will go up as you grow your EBITDA, as you grow your revenue. You're much more valuable as a $200 million company with steady $20 million EBITDA than if you were a $20 million company with $200,000 in EBITDA, right? You're going to appeal to strategic buyers that may be your competitors, and you're also going to be able to appeal to financial buyers that are looking at you as part of a larger strategy. And it may not make sense for them to purchase you or look at you if you are smaller. And I say that with lots of asterisks. Okay, after that, saying that as general advice.
All things being the same, that is true. But in many cases, all things are not the same, which is why I don't like to prejudge, and I think it's important to engage in conversations with business owners before coming up with any sort of assessment as to reasonable pricing. And next one, so we're on to food and beverage now. And again, a chart with a lot of ups and downs. There were some very large transactions in here, which are going to skew some of the numbers. But looking at things from a subsector standpoint, packaged foods and meats, restaurant and beverage were the drivers. And a few interesting things there. So on the packaged foods and meats and beverage, and this ties on with a subsequent following slide, there's a demand for convenience. And the demand for convenience is driving a lot of product preferences and acquisitions of such companies that are able to deliver on the convenience side of things. Restaurant demand is that is a post-COVID, semi-post-COVID. Maybe you can hear from my voice. It's not entirely post-COVID, but a semi-post-COVID phenomenon, which is restaurants were extremely hard hit. But now that we're through a lot of that, the ones that survived, had good balance sheets, etc., are on the move. There's been a reduction in the supply of restaurant, so naturally capital moves in to buy such companies and to grow them. Another thing that I also want to touch on too is food and beverages, the value of brands. It may seem obvious, but the value of a brand just cannot be understated. You know, some companies do very well white labeling, where they're really on a low cost and quick turnaround proposition to their customers. But other than that, the power of branding, which brings together pricing power, negotiating power, say through to the retailers, and the themes of better for you and free from remain strong in the food areas. And on this table here, even though you see fast food, which is the purple line on the top left,
Right.
as number one, that may sound counterintuitive to what I just said about better for you and free from, but it's really convenience. In other words, some of those things that are in fast food, they're convenient, but with a differentiator with inconvenience can be, you know, how healthy or unhealthy is this? That's a continuing trend, not going away. Definitely demographically, it seems to be that the interest in the proposal of a brand being free from or better for you is only increasing. So again, we see that with our clients when we strongly emphasize brand value and positioning and ability to push through cost increases as being vital. And these are things that drive up value. You know,
And John, you know, I was when you sent over these slides, it was really interesting to see the drop in processed foods. And
yeah,
I know I have a few clients in this space here, and much of that drop in value is because of the risk of the international supply chain, the
right,
container issue. So it's just much more of a riskier proposition now. And you can see the significance, you know, in terms of the valuation multiple drop. So
yeah,
if you were a $10 million EBITDA company right here, and let's say that was 15, it's $150 million in terms of value, and then it dropped to about let's call it 11.
hmm,
And so you're now giving up about $40 million worth of value.
yeah,
One that's really interesting, John, is, and you can kick me for asking a hard question, is natural foods, right? I
I
mean,
know,
what's going on here? I mean,
yeah.
the trend is moving towards natural foods. Why is the valuation stayed basically the same?
Yeah, that's very surprising. And short answer is I cannot explain exactly why. The longer answer might be that there's a flood into the market of things branded as natural, and a lot of the players remain on the smaller side, not small by our standards of our client base, but smaller than the Pepsi type companies. And I think it's been I think it's hard to truly stand out if they lack scale or if they're in a crowded market. I also wonder if there's a branding issue with some natural foods companies, in that if a consumer is going to a store, are they looking to buy something that's natural, or are they looking to buy the specific brand?
Right.
Because if they're looking to buy the specific brand, then it is differentiated itself from competitors. But yes, that is a surprising result.
Yeah. So we just want to open up a few questions now, and a little bit of a we'll wait for some questions to pour in. I hope we've answered some of the questions you guys have posed well, but this is our contact information. It's directly to my cell phone and John. So, please feel free to give us a call if you have any questions, or drop us a line. We're both based in the GTA. So John is in the Tri-City area and Waterloo, Cambridge, Kitchener, and I am based in Southwest Ontario, just west of Burlington. So, happy to come and visit you, chat with you. And you may have specific questions, or your industry may be going through something very specific that we have not talked about here today. So, John, I'll ask a question because I don't see any questions asked here. And so, John, I guess my question is, I'm seeing a lot of my engineering and construction clients, and they're going through a hard time right now. Access to skilled labor, projects are on hold, and obviously the future looks bright for that business. Lots of building and spending on infrastructure, but a lot of those businesses aren't realizing their full multiple. They're being created, it seems like, at book value, right? So what's going on there? What's going on in that industry? Is there an opportunity?
I think there is. Yes, traditionally that was very much the case. If they're a construction company, they win a job, or an engineering company, they work on the job, they got to win the next job. So it's less of a recurring revenue model. I think one of the differentiators that are available for many businesses, that because construction in particular has been lagging in adopting, is IT and systems that would save costs, deploy assets better, perhaps review assets, and and change some of the mix. Some construction companies, some people claim, are overly asset heavy, and it's not required to generate the cash flows that they're generating. But nevertheless, unlike a manufacturer of bread, where bread gets consumed every day and has a wide distribution network, the consumption of construction and engineering tends to be episodic. And not to say that they don't continue to have revenues, but they're always having to refill their pipeline with projects. There are some cases where you get multi-year projects, or the other thing that can indicate some more sustainable value is seeing that the same customers that are quality customers are coming back all the time. So that one would presume, or one would like to think, that they're not just in a low bid situation always, but they are able to communicate to the customer that they are very successful. The customer doesn't need to worry; it'll be done right and on budget. So that does create some goodwill values, but nevertheless, it doesn't completely depart from the fact that, as I said, they're not they don't bake bread and sell bread. It's very, very episodic.
So, John, we have a couple of questions rolling in here. Maybe we'll limit it, just because there's a number and we want to answer them. So we'll limit it to about 45 seconds. And so,
Sure.
Question here from Henry Martinez. Thanks, Henry. And his question is, any thoughts on financial services and software? What's going on in that space?
I'm by no means an expert, but it's massive. I mean, you've got a number. So I was looking the other day at property and casualty brokers, and their massive deployment of software to streamline credit adjudication and to streamline onboarding customers. Massive. There are large financial institutions and smaller financial institutions that are adopting technology very, very quickly to reduce costs. And of course, once one does it, the others are at a cost disadvantage if they don't do it as well. I was looking at a company also that provides non-bank financing to individuals, and they have it down to an absolute art, where despite the fact that they're lending at a higher risk, not terribly high, but higher risk than a bank would, they can adjudicate credit and receive approval in no more than half the time that it would take a major bank. And that is because of the systems that they have. So that provides the people who give them the leads, the people that need to borrow the money, look like they're providing great customer service, because they get approval in a day which is quite remarkable. But it's all, it's not artificial intelligence, but it's very much a multi-factor analysis that's being expedited by the fact that it's there's a lot of computer churning in the background that allows that to happen.
So I'll take a question here, and thanks, John. I'll take a question here from Rich. So Rich asks, is there a way to transfer the expert to make the business more saleable? And this is, the most common thing we see that impacts value. Yes, there
Yeah.
is. And Rich, what you have to do is you almost have to take those things that the owner does and metaphorically stick a vacuum to that person's head and pull it out. You've got to document some of it. Some of it you've actually got to bring in someone that can do that work. So I have a client that has brought someone in and has given them a substantial share of their company, something that they didn't need to do, but they hired away one of the best people in the industry, gave them, I think it was about 10% of their business. And some might say, hey, why are you giving that person 10% of your business? But they were able to get much more in a multiple, and they sold that business, and they were able to take a little bit more time off from the business. So that's one of the things you can do in terms of bringing in someone. Maybe if you're 60 and looking to transition to business, bringing in someone that will have a longer runway in the business. The other thing is deploying technology. So are there some things from business process improvement or technology or running your business differently where it's not so dependent on you? I will tell you this. It does make an impact when someone walks into the room and they say, John, tell me about your business. And you say, here's the book. Everything's in this book. And this is how my business runs. And a lot of businesses don't have that documented. So thanks for that question. I think I want to move to Hector. And Hector's asked 2 questions. And so, John, I'll combine it and you can answer this. And we have about 45 seconds just so we can get through the question. So, John, can you explain how working capital works when you're selling a distribution company?
Yes. So working capital is an often misunderstood aspect of selling a business. And the theory to working capital is that there are certain assets required to generate revenues and profitability upon which the company is being valued and acquired. Some of those assets are, equipment. It could be racking, things like that in distribution. But another asset is working capital. So you have your receivables, and you have your inventory. I'll just keep it very simple. It's receivables and inventory, and you have accounts payable and accruals. And the net difference between those is a dollar amount. And that's the amount that you would see on your balance sheet, plus or minus, on average, every day. And as you grow, that amount grows because your receivables and inventory will be, in most cases, larger than your payables, and that's why you have an operating line and you have to finance it. So the idea between in looking at working capital and a distributor or any other company for that matter is to calculate what the average amount of working capital was over the preceding year, typically, and say that is on average the amount of that asset, even though it goes up and down, but it's an asset that goes up and down. How much of that was needed to be in the business for the business to generate over the same course of time, a year, revenues and profits.
John,
Yes.
Sorry, John, I'm just going to cut you off there because we're at one.
I'm going to run out of time. I'd be happy to have this conversation offline.
Yeah, we'll
have that
offline. I just want to say, Mark, thank you for your question. I'm going to mark a note here, and John or I will get back to you. So we'll make a note of this question, please, if someone can capture it from our end. And John, I'm sorry to cut you off. Really appreciate you slugging it out, even though you have this cold. So thank you. And really want to thank all of you here in joining us today, learning about what some of your options are. It's certainly great to understand what drives these values, to understand the questions that people are going to ask you. And we are definitely, I see Leanne here has a question on Mark's question as well. So we will try to catalog the answers and send them out to everyone.
That sounds good. Yeah, thank you very much. Thank you, everybody.
Thanks, John. Great job.
Thanks, Johan. Bye-bye.
Bye-bye.